Thank you for joining, everyone. Appreciate you being here on time as I joined us late, so I apologize for being a minute late. We'll start in about 1 minute, 90 seconds as a few more people trickle in and get the presentation started quickly. All right, we'll call that a minute. So again, thank you for joining today's webinar. Appreciate everyone who takes some time out of their time today and hear this presentation from Rob and Devesh. Before we get started, I want to run through our disclosure. This presentation is for educational purposes only. Camel doesn't provide any investment advice, and we encourage you to go and do your own due diligence and seek out the advice from the appropriate professionals before making any tax or investment decisions. Housekeeping issue. We will have the chat turned off during the presentation, but you can ask your questions, and your questions are highly encouraged via the Q&A function within Zoom. So please don't be a stranger, ask questions. It's always a lot more fun when it turns into more of a dialogue. So please ask those questions to the Q&A function in Zoom. And then finally, if you have any questions about self-directed IRAs, how to get started, anything like that, you can reach out to our client team with the contact information in front of you. So without further ado, Devesh and Rob, I'm going to turn things over to you. Go for it.
Great. Thanks for having us. Looking forward to it. Rob's going to kick it off.
Yeah, I'm just trying to bring up the slide deck.
Are you sharing entire screen, Rob? If you toggle over to the presentation, it should pop up.
I'm not seeing that, but sorry, Matt, do you have the slide deck that we sent?
I sure do.
Okay.
Do you want me to put it up?
Yeah, I'm not sure why it's not coming up.
All right, go ahead and click stop share on your screen, please.
Okay.
And I'll pull it up right now. Is it showing up for you?
Yep.
All right.
And can I just click on share and then I'll be able to bring that up?
Right now I have control of it, so
Okay.
if you want to advance the slides, you'll need to tell me.
Got it. Perfect. Great. Well, thanks everybody for good morning or good afternoon, wherever you might be checking into this webinar on. So my name is Rob Countryman. I'm the president and CEO of Countryman Capital Partners. My firm focuses on essentially raising raising financing and capital for commercial real estate projects. I'm going to have Devesh introduce himself as well. Devesh Nirmal. We work together on a lot of commercial real estate projects on the energy resilience side. So Devesh, do you want to introduce yourself?
Yeah, good to be here, everyone. Passionate about high performance real estate and just really trying to think about how to get that performance right with energy being a big part of that focus. And we're looking forward to sharing with you what's going on and what we see as important opportunity to be focused on from an investment standpoint.
Just real quickly, my background, 30 years of commercial banking, focused on a lot of commercial real estate financing. And then when I started my practice, one of the things that Devesh and I met at a clean energy conference a couple of years back, and feel like there's an increasing, certainly increasing costs on the electricity energy side. And both Devesh and I have backgrounds in commercial finance, structured finance, and real estate finance. So, and Devesh's background more focused on kind of the energy and sustainability piece. So when you look at sort of my clients that I'm working with right now, increasing energy costs is a major issue. And I would say typically when I do a presentation, I'll have folks raise their hand and say, how many folks in the audience feel like interest rates are going to be higher 5 years from now? And so maybe half the hands go up. Then when I say how many folks in the audience feel like electricity or energy costs are going to be higher 5 years from now than they are today, every hand in the room goes up. And so this is a big issue facing a lot of my real estate clients who are building new buildings, but also own buildings, trying to refinance buildings. And so those are when we talk about the convergence of finance and energy, that operating costs of increasing and rising energy costs is a major issue for a lot of my clients who own commercial real estate. So that's where we feel like there's a real emerging opportunity from an investment and finance standpoint in what we call middle market real estate. Again, a lot of the bigger property owners, they've got funds or resources to take care of that. Our focus is on a lot of the building owners have deferred maintenance and things that they need to address, and so that's what we're going to talk about. What's going on in the real estate market in the kind of the middle market commercial real estate, and potentially ways for and from an investment opportunity to help those building owners address some of those issues. So. And hopefully it'll be educational. There's a lot of things that are happening, obviously internationally these days on the geopolitical front, but certainly in the commercial real estate space that hopefully you find some information that's valuable to you. Matt, you want to advance the slide? So one of the key, if you have one takeaway, back one slide. One takeaway from this presentation really comes back to increasing electricity demand. So this ICF International is a large consulting firm that works with the U.S. government, but this is their estimate on energy or electricity, U.S. electricity demand, over the next 5 years, 6 years, and then up to 2050. So as you can see, energy demand is exploding. So the questions are, why is this happening? And one of the things that Devesh and I have learned in a lot of our interactions with the utilities are under stress, right? So the utilities, think about a utility, straight and steady, right? Utilities kind of do their thing, and it's like a barge. They don't go right or left. So they've been able to kind of look forward and address these big, increasing energy costs or increasing energy demand. But they're under stress right now. A lot of grids across the country are under stress because the utilities don't know how to keep up with the demand.
And to your analogy, Rob, just to say that you talked about a barge, think about a large wave hitting a barge like that. That's kind of what we're dealing with. It's not slow, steady. And it's truly that electricity component, given what's everything going on, that's increasing. But we'll break it down even further as to what is going on with the rates. I'll let you continue, but I think and I want to mention that the level set on the Class A real estate, we're talking about mid-market, but for many years, Class A commercial office was the prime piece of real estate for the large institutionals before pre-pandemic. And they were always focused on energy because typically if you didn't focus on it, it was a top 3 operating cost line item, right? So Class A got their act together. You see a lot of Energy Star labels on Class A buildings, and they try to push that down to be like a 5, 6, or 7 line item. And there's some really good transformational stories. But you think about the asset classes we're dealing with now in commercial real estate that are prime, and how are we, whether it's multifamily, senior living, a lot of this inventory stock, and then existing buildings, older Class B office, et cetera. Um, it's a lot of opportunity to kind of address that market, which we know Class A did a good job of pre-pandemic. Go ahead, Rob. Yeah.
No, great. Thanks, Devesh. And then, things that are happening across the country too, is certainly electrification. There's been a lot of focus on electrification. So a lot of grids are really focused on that piece of it. Certainly, EV demand is part of that. Increasing weather events where we're seeing hotter and colder temperatures. I'm in the Pacific Northwest, and so from a standpoint of even air conditioning, years ago people say, well, you don't really need air conditioning, in the Pacific Northwest, but that's changed. So there's a lot of things happening on the weather front that has impacted energy use as well. And the big one right now that has the utilities panicked is AI demand. Basically AI and data centers. So that is zapping up a lot of energy, and you'll see a lot of articles about pay to play and things like that. But that's definitely got the grid under stress. And so again, part of our focus is really how do we help those mid-market real estate owners address that gap and make sure their buildings are efficient, address deferred maintenance, things like that are causing some of this big zap in energy demand. Next slide. This grid here. Really the focus. There's a lot on here, but essentially the focus on the right-hand side is that U.S. buildings consume about 40% of the energy, and 75% of the electricity used is really on commercial buildings, as well as just carbon. On the carbon side, I mean, the 40% of the carbon side is really focused on, release is really focused on those 40% of those buildings are producing a lot of the carbon emissions, which, again, it's an area that we're trying to reduce, across the country. So next slide. And Devesh, jump in on some of these slides if there are other things you want to talk about.
Sure.
This just shows a breakdown of where that commercial energy is consumed. The key focus here is really looking at, kind of that HVAC piece is a big, 40 to 50% of the, usage is really HVAC. So it's heating, cooling, the ventilation piece. And so those are big, certainly on the commercial real estate side for my clients, those are big areas and big operating costs that they need to kind of keep in check and keep insulated or insulated from rising energy costs. So anything else, Devesh, on that slide?
Well, no, to your point about the fact that the extreme weather events, what happens is that if a building has to all of a sudden put HVAC and they haven't had it before, that scales up for the utility. That's many buildings doing that at once, and that's what's stressing the grid. That's creating that energy demand change. So the wave that we talked about hitting the barge is just getting higher in amplitude, right? With just one type of extreme event day affecting a business decision for multiple building owners, right? And so it's not just that, we have to help owners think about, well, if you have to put HVAC additional on, how efficient can you do that? Because you're now adding to the stress, and your costs will go up, increasingly, not just linearly, but there'll be some sort of multiplier effect because everybody else is doing it as well. So go ahead, Rob.
Next slide. This slide here really kind of shows the number of commercial buildings out there, but the takeaway or focus on this is really kind of looking at that yellow section there, because if you look at most of the energy consumption is kind of that mid-market, smaller buildings, which are kind of qualified there at 5,000 to 100,000 square feet. And again, that's probably the biggest area of opportunity to help those building owners make their buildings more efficient, or provide ways to finance that, or for them to increase their revenue based on energy sharing agreements, things like that. We'll talk a little bit more about those, but the takeaway, and again, this slide is really looking at that kind of gold or yellow piece there. That's really the middle market, mid-market commercial real estate market there. So
Yeah, and I'll just say to level set, Rob, on what we're talking about is that just to stay where you are financially on energy, you can't just sit still anymore for these mid-market. Despite notwithstanding the deferred maintenance and sort of the inefficiencies that may already be there because you haven't made updates in a long time in your building, your cost is going up, and it probably is going up at a higher rate every year. So just to kind of keep your economics where they need to be, either are you raising rents, what are you doing? It's probably more prudent to find ways to cut your costs and attract tenants and keep them there because you've got an efficient, comfortable building. So we'll get into more of that later. Yeah.
Yeah, and one thing back to the utilities, right? So when you think about, which I touched on briefly, but the utilities again are under stress, and a lot of areas like the Pacific Northwest. I mean, they're not going to be building new dams anytime soon, and it's a very long approval process to build any kind of new energy, a new electrical power plant or anything like that. It takes a long time, and so I think from a standpoint of the utilities are really looking at ways to help building owners conserve their energy and build more efficient buildings. So again, that's where the opportunity comes about. Next slide.
At least in some markets, Rob, to what your point, some utilities where you need to focus is where the utilities are proactively trying to work with building owners. It's not always the case. We work all across the country. I work in the Northwest too, but also work in the Southeast, and things are a little bit different down here. But we'll get into that. Go ahead.
This slide here really just is kind of showing where the highest energy intensities are, and that's really kind of the smallest buildings. I don't know if you want to call it a dumbbell, but that's kind of where the smallest buildings and then the larger buildings represent the highest energy intensity. And again, Devesh, I don't know if you want to say anything more on this slide. I know that it's a pretty busy slide, but
yeah, I think it has to do the small building side has to do with sort of the management culture of a small space like that. Why those are inefficient. It's going to be run until it breaks kind of situation. Um, in mid market, there's a little bit more intelligence on what's going on. But as you get into the 100,000 plus, you start to see, or even at 25, significant fuel intensity. And then the big buildings just tend to have some wastage because of their design and size. It's just naturally what happens there. So yeah.
So this slide, is it basic? I mean, not basically. Is it fair as a fair interpretation of this graph that the second and third row, the 5,000 to 25,000 square foot buildings are the most energy efficient generally? Is that correct?
Yeah, because it's
Okay.
intensity. Because you're
Okay.
talking about per square foot consumption. Yes,
Okay.
from a baseline standpoint. Yeah,
Okay.
correct.
all right, next slide. And this is really just kind of providing background information for what we'll talk about a little bit later in this presentation. So, and then newer buildings certainly are more energy intensive. I think the takeaway there is, again, we use a lot more energy in the newer buildings. They're more efficient than typically more efficient than older buildings, but they're just a lot more energy uses these days on newer buildings that have been built since 2000.
Yeah,
So that's just kind of the takeaway on this slide.
it speaks to opportunity across the board, right? Obviously, if you had a building built in the 1960, 1999, you probably went through some renovations, and you're still going through those. If you're built after 2000, if early in that process, you're probably going through a renovation. But a lot of these plug loads have been increasing. So ways to get ahead of that and ways to do that in a very strategic fashion, not rather than piecemeal, which we'll talk about the difference between those two approaches.
Next slide. Devesh, I'll let you run with this one.
Yeah, so we really want to break down what's going on. I think one thing, so I'm a certified energy manager is one of my credentials, and I always tell folks, if you're working for a company organization, even your home, it's good to take a look at your energy bill, right? Just to try to understand what's going on, and you'll hear about rate hikes, but those rate hikes get played out according to particular attributes of the bill that you can actually track. So what we're seeing is because of these extremes and stress from weather events, electrification, high demand like EV charging, whatever it might be that on the grid, really where we're seeing the impact is what they call the demand charge on a commercial bill. You'll be able to see these two charges split out. You'll have several line items that say kilowatt hours and several line items that say KW. And we're seeing a rapid increase in the KW side because it has to do with, let's go back to the example of all those HVACs being turned on buildings that never had HVAC before on a hot day, in one year versus the year before where they weren't there. That is a peak load event for the grid and utility and for all the users on the grid. Everybody trying to get that juice at the same time, and because of that, you tend to have a much higher charge back because of the when you are using energy at those times, and the rates for those usage times are going up, right? But there's different ways the utilities have a way for you to manage through that. There's time of use rates, whereby if you don't use a lot of energy at those peak times, if you're smart and you've got a management system in play, you get actually a much lower rate than anybody else during that time. So as I have here, the drivers, we talk about peak load, as I just described the HVAC example. Mitigation, I think for kilowatt hours in general, the more energy efficient you are, that's the way to mitigate your overall energy cost. And from a kilowatt hour standpoint, which is a portion of probably half of your bill is going to be kilowatt hour charges. Um, but also being more energy efficient prepares you to really be able to shave off your use during a peak load better, right? So these things work hand in hand. But ultimately, the strategies for managing this increasing demand KW cost is to manage that peak effectively and maybe even think about using storage. And once again, I have here the kind of trends that Rob went over: extreme weather events, temperatures, electrification, EV charging, shocks to the system like AI energy demand, the Mideast conflict, the pandemic. These are all shocks that we see that we have to be ready for as well. Next slide, please. This is an example of a bill here in Florida, my home state, that one of the utilities, TECO in particular, had increased their rates from 24 to 25. And I want to just kind of show you really tangibly what's going on here. So that this particular property we looked at, their peak for a particular month was 150 kW. And the way that charge works is whatever you, in this particular tariff, whatever highest kW you get for any 50-minute interval during the month is what your charge is. So in this case, the highest peak they had was at 115 kW at some point in the month. And in 2024, the cost would have been 1,612, and in 2025 it went up to 2,078. It's a 27% increase in KW charges. So this is happening all over in one way or the other. So I just let everybody on this webinar be aware to look into these things, or to make sure the questions are being asked of what's going on with these charges. We can go ahead and shift to the next slide. Rob?
Great. So this is a summary that I put together in a presentation a couple months ago, but my world on the finance capital side is driven by cap rates, interest rates, and NOI, which is net operating income. So when you think about a commercial real estate building, those are the things I'm looking at when we're modeling out a construction loan or modeling out a purchase, things like that. Our whole world, from a capital market standpoint, drive is really wraps around net operating income and again cap rates. So one of the business cases, and again, I've got a lot of clients who are like, they want to do the right thing and they want to build performing buildings, but if it's going to be too expensive, again, think about cost. Building costs have gone up significantly. Interest rates, peaked and they've come down some, but they're stepping up again. So when I'm looking at various projects for my clients and putting together pro formas and modeling out, looking for ways to reduce operating costs is extremely valuable these days. So again, when you think about if you're able to reduce operating costs on the energy side by being more efficient, that actually boosts the net operating income. And when you think about value in commercial real estate, it's the values when appraisers kind of put a value on a building. It's really driven by NOI, net operating income, divided by the cap rate. A capitalization rate, a cap rate, really is what investors expect or would expect to get return on their investment. And so there's different cap rates for different asset classes. So again, multifamily probably has one of the best cap rates, where you might be in, depending on what part of the country you are in, might be like a 5% cap rate or something along those lines. I do a lot of work in the senior housing space, and so you got something that if you have a property that's memory care, assisted living memory care, those cap rates might be high sevens, low eights, something in that range. But and then office used to have very stable cap rates, let's say 6.5%, 7% cap rate, and those have went way up because there's a lot more risk, certainly in office these days. But the conversation here comes back to if you can reduce OpEx and increase your NOI, that's going to increase value in the property. So those are the key things where we're trying to help clients reduce or make their buildings more efficient. And also, I think from the other thing we're seeing now from REITs and the capital markets, resiliency and redundancy is extremely important, not only for the building owner, but certainly for their tenants. And so there's a lot of competition, depending what part of the country and what city you're in. There's a lot of competition for office tenants, for example, right now. So you want to make sure you've got the best performing building, low operating costs. A lot of times a triple net lease, a lot of times those operating costs are being picked up by the tenant. And so those are areas, if you have a very efficient building, you're going to get more tenants, or you're going to, better tenants, things like that. And again, back to institutional private equity, REITs, things like that. If you're looking for an exit as far as value, REITs and private equity are really looking for those high efficient buildings now, because they're looking forward to saying, hey, 20 years from now, is this building going to be resilient, and is it going to be insulated from as much as possible from increasing energy costs? So those are things that are extremely important to building owners these days. I guess they always have been, but certainly they're increasingly more higher on the list, I guess, these days, given the fact that energy costs continue to rise rapidly.
And Rob, I would add, institutional have standards they've got to meet for global sustainability, et cetera, that drive their investments. So if you're going to sell your building to them and you've got these credentials built in, performance metrics, you'll have a better opportunity to sell.
Yeah, and a lot of states now and cities as well have adopted, or various jurisdictions have adopted building performance standards. Again, there's two components. We're trying to push more energy efficient buildings, but also carbon reduction. So like for Oregon and Washington, California as well, they're building performance standards now that these buildings have to meet. Certain size buildings, depends on where you're at, but let's say 20,000 square foot building or larger. They're going to have to be able to hit these building performance standards, or potentially you get penalized. And again, if you look at somewhere like New York City, I was just back in New York last week, and a lot of building owners, they haven't upgraded their buildings, they're paying big penalties. So it's kind of the carrot or stick thing. So, but we're seeing, a lot of jurisdictions across the country adopt building performance standards. And so when we're advising our clients, that's one area you got to look at too. Can't ignore it anymore. These are being implemented now, same as like building codes. They're rolling out across the country. So those are key areas that my clients need to look at when they're looking long term at their buildings performance, capex, things like that, the capital expenditure plans and stuff that they need to have in place. Those are key and important. And also improvements in energy efficiency. I mean, there's additional tax credits and other incentives in place to help on that as well.
For the tenants who are, the potential tenants who are looking at this, do they appreciate the do they appreciate what the impact of sort of energy efficiency does, or does that kind of education need to be take place between the landowner, the property owner, and the tenant, and kind of direct them to the bottom line? I mean, are the tenants demanding this, or does it need to be they need to be like led to the water a little bit more to understand it?
I would say it varies. I say if you have an institutional tenant, sometimes you'll find that if somebody's building a spec building, and in order to attract the certain tenant they're talking to, they have to build it green or certified. In other cases, if you have an efficient building, it's important to let the tenant know that, hey, it's triple net lease, you're paying the bills, but guess what? You're going to be paying this much less than the building down the street because we have these efficiency measures installed. So it's a two-way street, but also then it affects the secondary variables on the pro forma of, how quickly can I lease up? Can I maintain these tenants? If I have to keep renewing tenants, I'm going to pay broker fees. So
Mm,
it's better for me to have a building that people want to be in. And comfort is so it's comfort plus cost. And comfort is, I'll give you an example. During the pandemic, the most efficient buildings were able to flush out the air in the building according to the OSHA standards for the pandemic because they had the capacity in their HVAC systems. Buildings that were not efficient could not do it. So that's where the resiliency and the redundancy and the business continuity, because that's the other cost, right? If the building goes offline and there's business continuity insurance policies to cover, there's ways to market. If you put a battery in a building that has backup or generation plus battery, and it can withstand a storm event, that should be a key selling item for getting that property, that tenant in that building, and that tenant should be able to reduce their business continuity coverage
mm,
Yeah,
premiums.
there's a very interesting interplay now with insurance, right? From an overall standpoint, having redundancy, backup, and be able to kind of continue to operate your operation if there's a power shortage or spike or ice and storm, whatever that might be.
Like Texas.
Yeah, that's where the insurance companies, and again, back to what Devesh was saying, business interruption. If you have a sustainable property with energy backup and redundancy, your interest rates are going to be your insurance rates are going to be lower than a building across the street. So that's getting to be a bigger piece of back to my comment about reducing OPEX or operating expenses. If you're able to reduce because you have an efficient building, you're able to reduce your operating expenses on your insurance. Again, that boosts the value, NOI, and the value of the building. So those are conversations that my clients listen to,
hmm
even though you're spending more money to make your building more efficient and more redundant and resilient.
So NOI captures everything we talked about, Rob. I'm glad you brought it up because all the secondary and primary impacts to the pro forma that we talked about with, in fact, leasing up quicker and stabilizing quicker and maintaining those tenants and lower operating costs across the board for tenants and owner, all that affects NOI. So
This is a very crucial slide because I think it comes back to the investment and opportunity going long term is like this is why it makes sense, and this is the opportunity to say how do we help these building owners bridge that gap from a financing and a capital standpoint. Next slide. So this kind of lays out the next couple steps here because we're going to talk about different investment buckets. Next slide, Matt. So kind of when we're looking and we're working and advising clients, I mean, these are kind of the different buckets of investment that we're in conversations with. So bucket one is just energy efficiency, clean energy. We'll talk a little bit more about what those look like and also some examples. Bucket two, enhanced energy. These are more sophisticated investment projects, property and financial resiliency. And then last is like major energy resiliency, which we've got some examples there too. Might be geothermal, things like that could be built into a property. Next slide. Devesh, I'll let you run with this.
Okay, great. Yeah, so we just want to kind of categorize things so we can understand sort of like the different buckets of opportunity and need in the market, what we're seeing out there. It's not a very they're not mutually exclusive. They run into each other, so it's not sort of a perfect sort of bucket type of thing. They're all a continuous stream, if you will. But the fundamentals, we talked about a lot of these mid-market having deferred maintenance that, you could go to any building and say, well, yeah, you probably should have replaced your HVAC 2 years ago or whatnot. But where we're seeing a need is properties that are trying to restabilize and lease up. Maybe you have a new investor who bought it and they're like, well, we want to create success here. We need to differentiate or reposition the property. And then, as we stabilize and lease up, we want to maintain tenants. We want to be the building that everybody wants to be in. So the scope here is your typical mechanical, electrical, plumbing that needs to get updated. It could be a high efficiency HVAC retrofit. We talk about something called commissioning of systems, which is essentially making sure systems are working according to design, right? You do this when you launch a building, you do it when you into operation to make sure things are working as designed. And you also have a thing with all the technology and AI that we have today. We also have continuous commissioning, which is the idea that my building management systems and energy management systems will be monitoring our building and letting our facility staff know, or our HVAC contractor or whoever it might be, things are off and they need to be addressed before it blows up and becomes a huge cost and a huge expense item for multiple reasons, right? But also uncomfortable for the tenants. So that's an important part that is more on the soft cost. It's a service, but it's important. And then you also have all this electrification going on. You have solar coming in, one-off solar projects on buildings. Maybe you want to do hybrid domestic hot water lighting. Typically, what we see with lighting is the problem with that is if you go in and do an LED retrofit on a building, it has a really quick payback, but you've now cannibalized some of the longer term paybacks. And furthermore, we'll talk about, I'll give you an example of whenever you change something that affects the energy or heat load in a building, you have to sometimes think about the bigger impact and that these systems work together. So if you change one thing, you're affecting how another system works, and you may have a result that you didn't expect. Like maybe people are not as comfortable anymore because before the lights were providing some of the heat, and now they're not, right? So just want to make a footnote there. The underwriting focus, obviously, NOI, how that affects the value of the building as stabilized, including all the improvements you're suggesting. And then you have to look at the debt service cover ratio. This is Rob's territory. Terminal value at the end, if you're going to sell the building or somebody wants to buy it, or you want to think about, as you reposition. And we want to definitely lean on some energy modeling and or basic energy assessment of potential savings that come through those improvements. And the size could be anything from 50, 100K to 2 million, roughly. The term for something, a lending of this type, it could be that this is a bridge situation to get them through the construction before it goes to permanent. So we're talking 6 to 3 years, possibly. And let me, I have an example of a project I was working on. It was an office retrofit in a small Ohio town. Nearby, there was a lot of, I think, activity going on in the technology sector, industrial, and that was driving some of the interest in having tenants wanting to move in this building. So let's shift to the next slide. So this is that office retrofit where it's about roughly almost 800,000 typical improvements. Existing building, Class B, lighting, mechanical. The owner of this building owned several other had a scheduled real estate of similar types of assets. Was doing well, but wanted to make this property perform. It was not anywhere needed where it needed to be on the sort of occupancy, right? They wanted to invest in it and improve it. So these investments that we talk about we call them energy investments. They're actually standard building improvement investments. We're only talking about the energy dividend here, but there are other dividends related to this type of work. This work has to get done, right, to get your property stabilized and operating to full capacity. And And you can see kind of where the cost is on this and sort of what we're looking at this scale. Next slide. Now we look at a more thorough analysis of what these impacts are on the energy side. And you'll notice there's some really long paybacks here. Upgrade building envelope, system, new roof installation. Now, this stuff probably had to happen anyway. So the idea here is if we're going to have to do it anyways, let's go ahead and make sure we put a cool roof coating in to reduce energy heat gain on the building, which would have an impact on the ongoing energy performance. Domestic hot water, tankless unit. We know about tankless units. Heating, cooling, ventilation with new RTU. Often these rooftop units wear out over time or are not maintained correctly, performing very inefficiently or not providing cooling or heating at all. Sometimes they're sitting there running and wasting energy and not doing anything, right? And often when you put a new RTU in, you may have to actually increase energy consumption a bit initially because you're having units work at full capacity, but you're at least making everything efficient in the process. So while these paybacks are quite long, what we say in the energy world is you want to try to make sure you do all this stuff together. You don't try to piecemeal, like do the lighting only. If you were to do an effective combination of all this solar plus all of these other improvements, we're still at a very long payback of 37.1. But there are other things to look at. Like you said, you're going to stabilize the property. You're going to have your full rent coming in. People will be comfortable. There's probably really good insurance savings to be had by improving MEP. And then we know that the energy demand, we talked about this up front, demand costs are going up dramatically. So the modeling here on this payback could be more sophisticated. We could have a 20-year cash flow and talk about exactly how we're hedging against future energy cost increases. And these paybacks would probably look different with that approach. But what I would say for you all and for us, this building sat for almost a year, not moving on their project, and their project had 400,000 of USDA grant money coming in that was going to pay as you started the construction. So one of the groups I work with got them a business loan to get started, so they could start to see some of the grant money come in, and then finally we were able to get commercial PACE financing deployed on this project as which is both it's more of a permanent solution, but it works great for retrofits if you need the money. What we think should have been here is a good bridge loan to come in to get these guys going on time to stabilize as quickly as possible. Next slide.
Yeah, I think just to highlight too, back to this, Devesh had mentioned CPACE. So that's Commercial Property Assessed Clean Energy Funding. I mean, that's a very rapidly growing part of the capital stack too, which, again, when I was back in New York, this is for Pace Nation, which is really a nonprofit that focuses on that. That's something that we use a lot with our clients, and it's you can do it in 40 states across the country. There's a lot of funds that are from life codes now that are focused on CPACE. So I just wanted to highlight that too. A lot of times that's what I'm using with my clients in conjunction with senior loans to get projects done and make sure they're efficient. So,
and Rob,
do you want to walk? Go ahead. Do you want to walk through these next two slides? So I know we're running short on time, so I just want to make sure we're moving. But
okay, really quick. And CPACE would have covered all those line items. It did yep. In most cases. Just it just was able to finance it. So what we see in the buildings right now, folks, that what I just gave you an example is a typical scenario of you have an opportunity, you have a ownership wanting to fund a project. They may not have enough capital because they have mission critical spend or reserve is not available. You have a delayed or staggered implementation, is very inefficient. Non-optimal stabilization of property, cannibalization of those longer term paybacks as I mentioned, and you end up with suboptimal performance, right? Next slide, please. The idea of what we're trying to do is to change that through making sure we're bringing funding in at the right time and the right type of funding to get these projects in the wake of all these energy cost increases completed as quickly as possible and stabilized. So that's kind of where we're thinking the opportunity is on the investment side. Next slide. So bucket two is we're talking more about doing some more sophisticated types of projects. Maybe you're going to have a battery clean energy storage. You're going to have some software, some building management system control software to be able to kind of behave in a way that you're interacting with the grid. Rob and I work on grid oriented buildings through Urban Land Institute in the Northwest on an initiative. But the idea here is how can I be a smart energy manager of my building and benefit financially both from a decrease energy cost, but potentially a revenue as well. The line item coming through that process. Next slide. Here's
Yeah,
a high performance building. Rob,
I'll
go ahead.
jump on this. So this is an example. PAE is a green engineering firm that's based here in Portland. But they do projects across the whole country. This is a building that we financed right at 2020. So right as we went into COVID, we started construction on this property. But the great part about this building is it's a living challenge building. So essentially, it's a completely, we'll call it a net zero building. So and it's very unique because it's a privately owned building. So versus there have been other living buildings that are public buildings, but you can see this graph here shows how they were able to kind of reduce the energy usage and flatten that out. And so, and again, from a comparison standpoint, you look at sort of minimum code, the improved HVAC, they were able to lower their operating costs significantly by kind of flattening those peak times out. So one of the other things we talk a lot about with our clients now too is peak load, right? So when are you using that energy, or are you using it, are you able to store it? So a great part about this building is, it's all self-contained. So you think from a standpoint of having batteries that are in the basement, they're able to kind of store energy and then, use that when needed. So that's why you look at their energy usage is very flat. But even with that, Devesh, I know from a peak standpoint, there's still small, peaks or increases, during the day. But this is a very good example of a very, very high performing building. And we actually use CPACE, a strip of CPACE commercial properties as clean energy funding on the construction loan and the perm loan for this building as well.
Yeah, I would say two interesting things about this. So what we realized, we talked to the engineer at this property that we work with, that's a leader in the space, and they said that even though this yellow line is kind of flat, when they did a deeper dive analysis of their energy bill, they realized they still had some peak events that they could mitigate that they weren't doing. That they could actually turn this into maybe like a frown looking, not to be negative, but if you were to further shave off some of the ends in here, you'd have even a lower line and maybe a different looking line. But also that because now with the post-pandemic, the occupancy might be a little bit lower, but they have their battery to lean on to interact with the grid and possibly get revenue from the grid when there's not as much occupancy and there's spare energy available. The local utility now pays an incentive for that battery service back to the grid. So just to keep that in mind, it's going to be more opportunity as if you have a building that's efficient as you move to the future.
Next slide. Let's move to the next slide too. I know we're running short on time, but
yeah, and that's exactly the point. That last slide was about exactly what we just talked about, the revenue potential. So I'll be really quick, Rob. I'll just say, so the work we do at Grid Interactive, the idea here, and from an active energy management strategy for a building owner, and this has been going on for a long time. This shedding of load at those high peak times is something that the industry, going back all the way to, I'd say, the 70s, has been looking at, possibly 80s, in the Class A space. And then shifting loads to respond to a particular tariff that you've negotiated with the utility so that you lower costs even more. And then shifting to consumption. Maybe you're going to pre-cool the building at night so you don't have to use as much HVAC during the day when everybody else is. And also to maximize renewable energy as well. And finally, if you have a thing like a battery in the building, you could actually provide service to the grid, what we call frequency regulation, where they pay you for the battery service for providing a particular type of service for the grid, not just the capacity. It's interesting. There's different business models for that. So revenue, key piece. Next slide.
So shed, shape, shift, and shimmy. So it sounds like a dance. Sounds like a dance move, but
right.
Make sure you memorize the 4 S's. But those are very key, and when we're advising clients with their buildings or retrofits, those are key areas to focus on.
And now here's a great example. This is a company out of Oregon that consults to clients, and of course, they have to be able to implement their software solution and maybe do some other consulting to create this result. But in this case, they were able to shave that peak continuously, The 100 kW, if they were to stay below that, dramatic savings. And that dramatic savings can be seen in the bar chart over here. In 2023, they cut both their energy consumption, kilowatt hours, and the kW, the demand I talked about, both by 2/3 roughly. Really great success here through the sophistication they brought to the building. Okay, really quick. We're also seeing now the idea of like, how do we take our energy uses off the grid, right? In other words, we can use solar, but if we want to just provide a different way, like geothermal is an emerging tool where I can take a lot of my heating, cooling, and domestic hot water off the grid in a big way by using the Earth's temperature, steady temperature deep down. And right now, the tax credit is still very strong for geothermal. It will be for a while because it does require drilling, and it's a focus of the current administration. And that tax credit applies all the way through all the building components. So this is another investment opportunity. Could be microgrids as well. This is going to be a larger ticket, maybe a longer term. Next slide. Here's an example of a pro forma on a geothermal, and just to explain to you what's going on with that tax credit. The HVAC line item, the estimated cost for HVAC, three different types of HVAC solutions for a particular property. You have your baseline, then you have another one, and then you have the geothermal on the far right. The geothermal is the most expensive, but the tax credit is phenomenal, and it gets the net cost of that project lower through geothermal than the other alternatives, along with the other benefits of the OpEx, the energy savings that we can see, the maintenance savings and replacement cost savings. So, once again, it requires a CapEx. So all these things we talked about, from the level one or bucket two, bucket three, the CapEx decision has to be made at a certain point. How strategic is that decision, and how well supported is it by financing? So what we got. Next slide. Let's see. Just a quick note on some of the things that would differentiate this type of lending. Next slide. From the energy side, I mentioned energy model. I mentioned the idea of commissioning systems to make sure they're meeting the energy model target, they're working the way they're supposed to, for example, providing the thermal comfort for the tenants. Prepaid maintenance plans. It's a really good idea to maybe finance up front we do this a lot with PACE financing, as Rob said. Bring in the soft costs. Let's get that 5-year maintenance contract in place to help us sustain our performance and comfort. And then monitoring. There's simple tools to be used that are available free, like Energy Star, or more sophisticated monitoring, as I said, through the building management systems. That's the next line, the continuous commissioning, the software, kind of what we just showed you with the car dealership example. The software monitors what's going on and makes decisions to avoid a certain result, which is that peak demand. And then, review of leasing contracts and revenue, just whatever might be in place. It's important to review all of that you end up getting your result, like in a geothermal contract, for example.
One of the things I was going to say is, we live in an era of data, right? So from an overall standpoint, we have so much information now, which is great. When we talk about, smart buildings, I mean, they know what's going on inside, under the roof there. And so being able to kind of track that data and predict that data is something where I do see AI is helping along those lines. But you got to have a building and the software in place that actually can track that. That's the next slide, Matt.
Yeah, and there's actually, so next slide is important because there's actually some very simple things we can do with AI without having to have sophisticated systems in the building. I worked on a project where we took the 15-minute interval data from the utility, freely available, and we had an AI firm that does energy twin modeling, they call it, and they were able to create this heat map. And this is a sample heat map of a project where they actually had made some improvements on a bank. Ideally, with a bank, you have set hours of operation. You should not be seeing any colors in the orange, yellow, and green spectrum in these off hours here in the morning. But a lot of buildings have drift, and systems get left on or not. The set points on the thermostats are off, and you'll see a lot of energy use when you don't expect it to be there. So with this simple heat map on any property we may be involved in investing and financing, we're able to take a quick peek, anytime we want with that data and see how they're doing, and that could then trigger some changes in how they operate the property. So
great. Well, I think Matt, I know we're running short on time, but I think that kind of completes sort of our little presentation, and I definitely want to have a couple minutes if there are any questions, that we can try to answer.
Yeah, thank you very much. So just a reminder to everyone, you can use the Q&A function to ask questions. We haven't received any questions yet. I think just as a summary, you gave a great, thorough explanation about the context for all of this, and I really liked how you pointed out to sort of all the stakeholders who would be really demanding this energy efficiency to be put in place for these buildings. For you, you work with investors. Can you kind of summarize what the investor opportunity is? If I say, for example, had $500,000 for to place with you, what is the opportunity? What's the ask? And actually, we just had a question come that question is, what is the ask for an investor?
Well, I think our focus is really on that gap. I mean, right now it's kind of that gap financing. So again, being able to get funding or financing for kind of these mid-market building owners, that's where we see that opportunity, and we're able to kind of provide that gap financing or gap investment piece. And I know from an overall standpoint, we've been looking at different areas and talking to folks on from a capital standpoint, building a fund essentially where we've got these, because we see these opportunities all the time. So really the key part is like as an investor, if you were interested in that, reach out to us and let us know, because we're trying to build that fund where we have the capacity to do these mezz debt lending or bridge funding to get these building improvements done. So that would be the play. So again, from an overall standpoint, if you're interested to learn more about those opportunities, certainly reach out to Devesh or I, and we've got an unlimited amount of opportunities to help building owners. So it's really the capital piece is what we're focused on, long term, building a sustainable and reliant funding source for that.
So with each of the buckets, there's sort of a increasing check size that needs to be written for each of those in CapEx projects, basically.
Right. Yep.
So the idea of the fund would be that you would grow the fund and be able to deploy capital into those different opportunities with varying bucket sizes. Is that accurate?
Yes. Yep.
And what are the kind of projected returns you're thinking right now, and minimum investments, things like that?
Well, typically we'd be looking at accredited investors. So kind of, and usually the minimum that we have focused on is $100,000 or more. So again, as we're putting that fund together, again, I'm not going to like pitch returns and things like that on what that might look like, because right now, as we see opportunities, we're going to various investors or sources to kind of help fund those. And we talked about CPACE as a funding source for that, and so we have groups that we would line up to fund something like that. But right now, for CAMA plan investors, as self-directed IRA investors, we're looking for those potential folks that are interested in investing in this fund that would allow us to go out and do these type of bridge financing, bridge gap financing. And again, I'm not going to project returns, but the demand is certainly there and the opportunity is certainly there.
And literally just pulling questions from the Q&A portal. Do you have any prior returns that you can share that would even a range?
Well, usually, I mean, I think for a mezz debt side, I mean, we'd be looking at something, 12 to 14% is kind of, let's say 10 to 12%, depending on the risk and opportunity. And that would be on a mezz debt pay, with fees kind of coming in the front end. Usually we'll charge like a 2%, fee on a mezz debt placement, where we would charge the client that, but those returns would be for the investors who would partner up with us on those opportunities.
Okay.
And I would say a play for that is I talked about that Ohio building. It sat for a whole year without funding. If we were to get 6 months to a year of that mezz debt type financing in place right away, and they knew they were going to eventually refinance to a pace at 7% or whatever, 7.5, that could be a very plausible scenario. We're talking about plugging gaps. There's also a gap with the tax credit. Folks that are waiting for that tax credit from the government or whatever they're going to get, they have to wait till they complete the project. So there's a 40% funding gap up front to do the higher performance project. They need that money now. So 18 months, the money could be out there for a certain rate, and then they would pay that back once they get their credit from the government.
Yeah,
So
same with construction and or adaptive reuse. I mean, a lot of times if you're able to kind of get the funding done, then you go to refinance it. So the other part is, if we had a fund put together, the turnover of that too, that money is recycled. So it really depends on how fast that comes together, would impact what your overall returns are on a go forward basis.
Okay. Perfect. And then I'm gonna have two more questions, and we have to wrap it up. What's the average project size?
I probably don't have an answer for that.
I
Average,
Yeah, I'll just say really for that level one, bucket one guys, it's going to be like I said, anything from 100,000 to like 2 million. That is really where it's at. Like maybe there's an elevator upgrade that has to happen along with an HVAC and that kind of thing. You're going to be under 2 million, but you're going to have. It's tough for them to get a bank loan for that. So it's an area of high need. And then when you get into we're going to have one of the projects. I worked with an institutional pace provider. We did a net zero retrofit of a office class B office building in the Northeast or Mid Atlantic, I should say. That had about 3.7 million of battery, solar efficiency, software, and the only reason the owners moved forward is they liked the fact that the PACE was going to provide them no money out of pocket opportunity to improve the value of their building dramatically, and improve the resiliency and NOI down the road. So it was really about not having to be on the hook for that money up front and creating that result. But that was 3.7 million. So I think when you get into the bucket 2 to 3, we're talking 2 million plus. So yeah.
Okay.
I mean, the idea would be to, from a fund standpoint, is to accumulate dollars, potentially from self-directed IRA investors, and say we're accumulating dollars to finance or fund opportunities like this.
Understood.
Okay.
What's the best way for people to reach you if they want to know more information?
My email, I think, is on the presentation. I can't remember. I think it is, but that would be the best way. And then our website is countrymancapitalpartners.com.
All right.
Yeah, I don't think the email's on this deck, right? Is it on the other on the camel plan introduction or
Yeah,
will
I
they
thought it was somewhere, but
Is your
maybe a
email
web?
rob@countrymancapital.com?
yes.
All right. Cool. Very good. Okay. Thanks very much for the presentation, Devesh and Rob. Really appreciate it. And for everyone to join us today, thank you very much for your time. We'll see you on the next one next week. And have a great week, everyone.
Thanks so
Thanks,
much.
everybody.
Thank
Have a
you.
All
good
right.
day.
Bye bye.
Take care. Bye.